Why Anthropic and OpenAI could be the new Lehman Brothers. Microsoft's investment in OpenAI looks to be a masterstroke, generating $31 billion of returns to date. But looking at the cash, it starts to look slightly less rosy. Microsoft invested $13 billion and spent $87 billion building out the data center. It's holding the bag for the infrastructure in exchange for $30 billion in revenue. These charts highlight the key issue facing the market. Every investment looks amazing project by project, especially on revenue. Add in cash flow and they move from great to good. Add in the sheer scale and concentration of the spending and they start to look concerning. A common pushback is that price to earnings multiples are not especially high versus the dot-com bubble. True, although Intel, Apple, Google and Amazon still look richly valued. On a free cash flow basis though, very little looks attractive. Google, Nvidia, Microsoft, Apple and Meta are all trading at 1 to 3% yields. Amazon, Anthropic and OpenAI don't even show up because their free cash flow is negative. AI may be game-changing, but that doesn't mean investors can't get wiped out. Google Cloud, AWS and Azure are all propped up by the spending commitments of two loss-making companies funded by themselves. For reference, Amazon spent roughly $200 million on capex in 2006 and $5 billion by 2015, buying commodity hardware and adding value through orchestration. Fast forward 10 years, and hyperscalers are spending 1,000 times that on monopoly-priced chips than selling compute to just two companies. That could still work, but it's very different from the cloud model investors loved. I've mentioned the loss-making nature of the model companies, so I found this great reporting from SpaceX's filing, revealing that Anthropic has a 2-month non-recurring discount to use SpaceX's AI facilities, possibly a contributor to the upcoming profitable quarter. Assuming Anthropic has committed at least $1.25 billion a year to both AWS and Google Cloud, cloud costs alone could hit $3.75 billion a month. At $45 billion in ARR, gross margins are effectively zero. The bullish argument is that ARR becomes 10 times larger over the next few years. Anthropic likely needs to grow revenue at least 5 times while reaching 70% gross margins. That requires major model efficiency gains, real pricing power, or far lower infrastructure costs. Either way, success here likely eats Google, Amazon, and Microsoft's cash flow. In theory, the cloud providers shouldn't care whether you run Anthropic, OpenAI, or Chinese models, as long as the workloads stay in the cloud. Wix isn't exactly a market favourite, but this snippet from last quarter stood out. Base 44 is already at $150 million in ARR, so if companies can achieve acceptable quality at 5% of the cost, that's worth paying attention to. Bad for Anthropic at scale, potentially fine for the cloud providers. The issue is that Anthropic and OpenAI are now systemic. Too big to fail. Once you account for 50% of a $1 trillion capex order book, nobody can really let you fail. So expect continued hyperscaler funding, continued capex growth, and declining free cash flow. But how can you sell when you're destined for a permanent AI underclass just because you sold your Google stock? This week's funding saw strong rounds across the UK tech ecosystem. In AI, Calibre raised $3.3 million to build AI infrastructure for the testing, inspection, and certification industry. RightBrain raised £3 million to help businesses build and deploy AI agents. In life sciences and biotech, Improgen raised £5 million for an enzyme engineering platform for pharmaceutical manufacturing. Kubertech raised £3.4 million for engineered dandelions that produce sustainable natural rubber. And Ptolemy Bio raised £2.1 million for software for cell therapies. In cybersecurity, Infrawatch raised £2.2 million for an internet infrastructure intelligence platform. Before we go, 3 events worth your time. On the 26th, in Oxford, during Oxford Tech Week, a health and biotech pitch session with Oxford Seed Fund and Oxford Capital. Submit your deck for a chance to pitch live to leading investors. On the 16th of June in London, hear from founders who recently raised multi-million-pound rounds on what actually helped them get funded, and on the 1st of July online, a strategic legal guide for businesses on how to respond when things don't go to plan. Links in the newsletter. We'll see you next week.